Welcome, everybody. Today is February 27th, 2025, and this NYPAY event is Fintech Forward Investment Strategies and Innovations for 2025. Just so everybody's clear, the session, we're going to dive into latest trends, opportunities, and challenges that Fintech investors will be facing this year. Our panelists will end up discussing emerging tech regulatory considerations and strategies for identifying what's coming up in exciting fintech ventures. My name is Ron Mazurski. I'm founder, board member, and officer of NYPAY. I'm also managing director of Pagility Advisors, a consultancy in the fintech payments and banking space. This NYPAY event was developed by Ed Delheim, Michael Flores, and me, and we hope you enjoy it. Just so everybody is aware, familiar with it, NYPAY is a nonprofit member association founded in 2006, and it's comprised of about 4,000 members that are senior executives in payments, banking, and fintech, a 7-person board of directors, and a 10-person events and advisory committee. Today's expert panel is comprised of a CIO, a bank CEO, and 2 investors, and they will introduce themselves shortly. NYPAY will continue to run one event per month throughout the year, as we have since 2006, and the topics will be posted on our website at www.nypay.org. I'd like to be clear, if you have any questions you'd like to present to the panelists, please type that into the chat feature, and we're going to have somebody monitoring that and bringing it up at the end of the session. Also, your email address or LinkedIn handle can be posted. Remember to save it. There'll be 3 dots on the top that allow you to save the chat itself, and you'll be able to have people's email addresses, etc., to contact them later. I do want to ask you all to remember to put yourselves on mute and to turn off your video. It's just a bandwidth issue to make sure we don't have any problems whatsoever in terms of running the session. And as soon as I finish my little session, I will also go dark. I now want to turn the session over to a good friend, David Peterson. He's the Chief Innovation Officer of the Bankers Bank, who will be moderating this panel. And David, I'm going to ask you if you could do a little introduction on yourself, as well as who the Bankers Bank is and what you represent. David, I'm going to hand it over to you now and to your panel, comprised of Brett, Daniel, and Adam. Thank you very much.
Thank you, Ron. And good evening, everyone. Welcome to this NYPAY session. As Ron mentioned, I am Chief Innovation Officer of First National Bankers Bank. We are headquartered in Baton Rouge, and we cover the southeastern United States, roughly where the SEC used to play football. If that helps you understand, we serve not quite 700 financial institutions as a correspondent bank. And as Chief Innovation Officer, all I do all day long is sit around and think about ways that our bank and also our community banks, how can we be more innovative? What are the ways in which we can get more creative about how we transform our branches, about how we attract and keep younger customers, about how we're going to deal with ongoing regulation and so forth. And fintechs all intersect in all of those different elements and the types of services that we sign up for, and a continuing number of smaller banks, under $1 billion banks, who are actively investing in or starting fintech companies themselves. So I got to thinking about it as I was preparing for this session. I started my career as a programmer working for what would now be the cores like Jack Henry and FIS. And then I actually went to work for a small community bank and became a senior VP of operations. And through that experience, I actually started a fintech company, Gold Leaf Technologies, that was around for about 20 years. So I was on the fintech side, and then I did a bunch of consulting with different fintech companies. Now I work for a bank again, and our bank is actually an investor in a fintech payments company. So all of those different elements are the kinds of things that are really the subject matter for us to kick around tonight, and to give us the insight, the wisdom that we really need to dig into these subjects. Of course, NYPAY has got a powerful lineup of speakers. Let me just quickly tell you who's going to be answering questions tonight. And then I'm going to ask each one of them in turn to just give a little bit more of their background and specifically talk about their perspective of what they're bringing to the table tonight in this particular topic of banking, investing in fintechs, and so forth. First, we have Brett Farr, and Brett is Chief Executive Officer of both Pathward NA and Pathward Financial Inc. We have Daniel Friel. He is the co-founder and Chief Strategy and Business Development Officer of DX Ecosystems, and Adam Hart. Adam is the founder and managing member of Wesley Hills Financial. And so, Adam, we're going to start with you. And if you will, I just would like for you to give that, little thumbnail sketch. Let them know they don't need to have the bio that your mom wrote for you, but give them the feeling, of what you're bringing to the table and what you think is really kind of a key element that you want people to think about as we come into this topic tonight.
Sure. Thank you for the introduction. I am about 20 years in as an investment banker in the payments technology and financial technology space. For the first 18 or so years, I did so as a consultancy. During the pandemic, perhaps counterintuitively, in 2020, myself and my younger team, we decided to pivot, and we stood up Wesley Hills Financial as the market-facing entity, but also our own broker-dealer in the process, so we could provide end-to-end investment banking services to companies in the banking, fintech, and payments ecosystem. Very briefly, I think what the perspective that I bring that I think is probably interesting to the audience, and also a differentiator for Wesley Hills as compared against some of the other larger middle market investment banks that may have a fintech practice, is that we have historically worked with fintech payments companies that are at the lower end of the middle market. So these are companies that have enterprise values between 10 million and 250 million. And most of our activity on the day-to-day is helping those companies, not just with high-level strategy, but in many cases, raising capital and M&A, whether that's on the buy side or the sell side.
Awesome. So again, if you're on this session and you're a fintech, or if you're a bank wanting to start a fintech, and we go to the breakout session, you just figure out wherever Adam is, and then you got to get in his good graces, right? So he'll invest in your company. That's how that works, isn't that right? Daniel, how about tell us a little bit about what your day-to-day life is like for DX Ecosystems?
Sure. And David, I hadn't put together the Baton Rouge connection, by the way. I did spend 4 years in Baton Rouge, so go Tigers. We'll talk about that later. So I'm also old enough, by the way, that was long enough ago that I was looking at and investing in fintech before fintech was actually a phrase. So I've been doing it for a long time. I spent a little time at a little bank you might have heard of, Bank of America, and we actually created a group. It was a forerunner to a lot of the fintech investing groups you see today. We called it Strategic Alliances and Investments, and our mission was very simple. It was a downward pointing radar where we wanted to go find emerging tech and figure out a way to do something with it. And that could involve investing in it, partnering with it, acquiring it, actually maybe spinning something out that we had built, all of the above. My day job today is I work with a partner up in Toronto who actually ran a big chunk of RBC's tech and ops, and we go find emerging tech globally and find a way to help them do more work in the North American marketplace. And I have a side gig, by the way. I happen to be on the board of a publicly traded company in Australia that focuses on cybersecurity and network management.
Outstanding. So you can have the T-shirt that says "I was fintech before fintech was cool."
You got it.
That's your T-shirt. Awesome. Brett, let us know what Pathward NA and Pathward Financial. What are you dealing with on a day-to-day basis?
Yeah, I want to thank NYPAY for having this. 40-year banker, everything from a banker perspective in very large regional sizes. About 6 years ago, I joined Pathward, which is a non-traditional bank. Even though it's a 70-year-old bank and was originally a community bank, it's totally a bank that delivers non-traditional ways through third-party partners, an awful lot of which are financial technology companies. And so the real thing we bring to the table is this concept of financial inclusion for all, and I think we're going to have a chance to talk about that. What that has meant over time changes. We've been in this business for 20 plus years, so we've got the scale and the operational capabilities to partner with all the people that are doing new and innovative things. And every one of them is finding a gap in the market. And that's what excites me about all this. And looking forward to talk about where some of those gaps are and how they can be filled and how they can be filled safely and how we'll be successful in doing that.
Awesome. And I know some of you that are listening in have either potentially started doing banking as a service or are thinking about doing banking as a service. And Brett has extensive experience in that. So again, as you go forward and thinking of the questions, the format that we're going to use tonight is I've got some prepared questions and I'm going to give those to one of the three panelists to answer that question. But then the others might have, it's sort of a little bit of an open discussion with the four of us here as we try to tackle as many of these questions as possible. But as Ron mentioned earlier, we want to also take your questions. So as soon as you think of a question, do not trust your memory that you're going to remember to key it in. Go ahead and key it into the chat as soon as you think of it. Here's your little no extra charge tip. The shortest pencil is greater than the longest memory. So look at that takeaway you got right away there. So here, let's kick it off. So Adam, I'm going to throw this to you first. And what one area of banking or payments that you feel is ripe for a new fintech solution that's not being addressed? What's the green field that you see? And then the others, you can jump in on it after Adam's had a crack at it.
It's not so much a green field. Well, it is, but it's more of a reset. And what I wanted to bring to the table tonight was banking as a service. It's interesting, very interesting to me that, not 3 years ago, attending Money 2020, one of the most active portions or parts of the sector, both involving banks and fintechs, was banking as a service. And, here we are today, or especially toward the end of last year, post Mercury, Synapse, Evolve Bank, I affectionately call it kerfuffle. It kind of got, stopped dead in its tracks. And one of the primary reasons for that was you had a business go under and neither the bank nor the fintech could identify or account for the users who use the fintech, where that money was, who was owed what, et cetera, et cetera. And one of the things that I've been following very closely, and I'm laser focused on it for this year, is that there are new solution providers out there who now have the ability to correct for that, especially in light of the FDIC. They sent out a letter for comment on new regulations, the essence of which would be that the banks would have to be responsible for and would have to account for that banking as a service model in the sense or in how fintechs were using it, which in many cases was a pooled account that was, perhaps FBO, but the sub accounts weren't being tracked. And so somewhat, maybe not ironically, but it's sort of born out of real-time payments. There are companies now that, because of real-time payments, have created technology that can account and ledger those sub-accounts in real time. And that is, to me, one of the biggest pieces to solve the banking as a service riddle. So, from my perspective as a banker, I'm very interested in the companies that have that technology. And interestingly enough, just today, I caught an article in Axios about another company that's addressing a different issue with banking as a service, which was the compliance piece, where, again, you have the fintech pointing at the bank pointing at the fintech, who's responsible for what. At the end of the day, that really gets down to liability. And seeing that ecosystem kind of regenerate, if you will, the green shoots of version 2 is very exciting to me, because it's a major potential revenue stream for banks in particular, if they can actually solve that problem and do it in a manner that makes the regulators happy and satisfied that the consumers, ultimately the users, are being protected and their accounts are being properly recorded.
Nice. So one of the things that is certainly prevalent to me as I really explore AI and where AI is going and all the different banking services is that there is no possible way for any service to not somehow be enhanced, and some company's going to come out with some AI twist to it, right? So AI is the, I don't know, the thing du jour, right? It's got everybody all excited in Gen AI. But I would just caution, particularly the bankers that are on the call, to just be very, very cautious about two things. Number one is, what outcomes do you seek? Is there a specific outcome that this AI tool is going to provide for you, rather than just the fact that it's Gen AI and it's doing this compliance thing or doing that marketing thing? And number two is be very careful about Gen AI applying to tasks that do not warrant Gen AI applied to it, right? So we're seeing a lot of Gen AI stuff to do kind of very simple, basic tasks. Brett or Daniel, any other thoughts on this question?
Yeah, so
Yeah. Go
David,
ahead.
just on your AI comment, and especially to the bankers in the room, the number one thing you have to be able to do AI is your data, and your data clean.
Yep.
And most of us old bankers have been around a long time, especially those with living with legacy systems, do not have that. So if you don't know what words like snowflake and ThoughtSpot are, you got to figure that out first, because AI is not going to do you much good.
And David, I'll add into that. I mean, the data, where the data resides. You mentioned, Adam, you mentioned regulatory issues, right, with 1033 and open banking rules and where that goes. That's all very interesting. And I must say, I've got a little deja vu around those, because I am old enough to remember when we actually started doing account aggregation. I remember actually bringing in an intern for the summer who wrote an account aggregation program that we played around with for, and by the way, he is now my wealth management broker, interestingly enough, in the small world category. And but that idea of getting to the right data, getting to the customer's data, can you get it out of the legacy system? Are you going to be required to get it out of the legacy system and share it with other customers if they indeed own the data? Those are all really important issues, I think, over the next several years.
Excellent, excellent. So Daniel, I think you're the perfect one to take this next question. So thinking about this idea of how the industry is positioned for growth, what are the biggest remaining gaps? Is it people? Is it process? Is it tech? Is it the issue like we just talked about that you're still going to have garbage in, garbage out, right, from a data? Is it regulations? What are those biggest gaps that you see when you're looking at these different fintech offerings?
So David, I'm glad you're almost as old as me. So you get the garbage in, garbage out, and Brett, that's the whole point on AI. AI is still garbage in, garbage out, right? You'll get really bad answers / hallucinations if it's being fed bad data, right? So that's the key. And David, I was thinking about this general question, and I was actually bailed out earlier this week by Jeffrey Moore, who wrote something that I'll share with anybody the link to what he wrote, but he said the speed of technology innovation has increased dramatically, and the speed of technology adoption has not. And the result of that impedance mismatch is that it's challenging enterprise leaders across every sector. And I can't agree more. When I look back at my almost 40 years of fintech evaluation and partnerships and investing, the biggest failure point is the mismatch between the fintech, the emerging tech, and the enterprise, and they talk different languages. And that translation piece is a huge, huge piece that you've got to figure out. And again, it can be very difficult to do. I'm also seeing this emerging gap between customer, client, and employee expectations and what the enterprise is actually providing. We're still, large FIs, we're still very siloed, and that silo creates channel conflict, right? I'll give you a perfect example, right? You've got, I've had this experience just last year. I got an escrow check because I apparently had overpaid into my escrow, or at least the bank thought I had. That turned out to be a mistake. That check automatically got deposited into my banking account, and then we couldn't get the money back out, and then there were all kinds of issues with the mortgage itself, right? And the bank, and this was the same institution, right? The bank and the mortgage part of the bank could not converse. So this whole idea of being too siloed, not giving that customer that integrate, we've got to meet that customer, our client, at the moment of need, and make sure it's channel across the channel. And so I do think there are lots of opportunities around that type of customer experience that we're not really getting in the FI world today.
Yeah, I add to that, David, a little bit. To this point, of different kinds of affinities, and this is sort of along financial inclusion for all. What a lot of our partners are seeing is there are a lot of use cases of the way people want to do banking that we're still not meeting. And as you get better and better tech, you can customize it, innovate it, and make it focused on very specific niches. And there's a lot of opportunity there. The other thing I'll mention is a huge opportunity, and Adam sort of went there a little bit, is the whole middleware play and banking as a service was a complete failure. And what I mean by that is I was on a legacy and I was going to go figure out what to buy to replace what we had that was old. And we kicked the tires on every one of them, some in the market now, some of them that are not in the market, and none of them met the standard of what you had to have. So there's still a huge opportunity in the middleware to really help novice new people that come into banking as a service understand how to safely do that and have those tri-party agreements that you need to do it properly.
So what about that, Adam? Just following up from Brett's comment, there are situations where, depending on the size of the bank, they're probably using a vendor for their core. They're using Jack Henry, FIS, Fiserv, or some other. And of course, even if you had the robust middleware that did a lot of the things that Brett was just alluding to, depending on what core you're tied to, they may or may not be getting gold stars for playing well with others. I'll just give you one quick example. We do a lot of settlement, for hundreds and hundreds of banks as a correspondent bank. So somebody signing up for FedNow, the new faster payment service, it indicates who they want to do settlement with when they sign up for the Fed. And so a bank recently said, we're going to settle with our account at First National Bankers Bank. They were a Fiserv, a premier bank. And when they did their first transaction, Fiserv shut their FedNow account down, shut it off, because if you want to do FedNow with Fiserv, you got to do it through their own bank. You don't get to choose your settlement. And I'm thinking, holy cow, that's not even an issue of technology middleware. That's just saying, it's our way or the highway. So Adam, what are your thoughts about this middleware, maybe specifically in terms of banking as a service, and how do we break that logjam?
Well, I mean, from my perspective, again, I think that there are solution providers out there now that have the technology. They call it either shadow ledger or digital twin that can reconcile and ledger accounts in pooled accounts, FBO accounts in real time. So the tech exists, but you bring up a very interesting point, especially as it relates to the banking cores, because I mean, they kind of span the spectrum and it's much heavier on the legacy side. So these companies can integrate with older cores, but that is it's very challenging. It's not very cost effective, and it can take a ton of time. Yep. I think it'd be hard to find an IT officer who's going to be around. I mean, it could take years. On the other end, there are newer cores like Thought Machine, by way of example, that they can just integrate into very easily, and you can get going right away. So, but what I've learned is that even though the technology now exists, kind of to Brett's point, I mean, he was talking about the quality of the tech. It brings up larger conversations internally within financial institutions because it's a major time investment, resource investment, money investment. You really have to know what you're doing. You have to have the right resources in the dev team. So it begs those other larger questions. Do we really want to do this? Do we want to kind of do it in a sidecar model where we'll take our old core and we'll start slowly transitioning it? Mm-hmm. These are major, major decisions, and they can be extremely disruptive. So what I wanted to bring to the fore was that the technology is starting to percolate. It's out there now. But it remains to be seen how quickly it can be integrated or implemented with the core systems and across the board with financial institutions.
Nice. And just for everyone, probably everyone on the call understands when Adam talks about shadow ledgers, but just a real quick example, if I wanted to start David's Bank, and I'm a fintech. I don't have an FRB ABA number, so I go and sign up. Maybe I sign up at Pathward, and I'm going to have my own account. I sign up 1,000 people online. All of that money is in a single account at that bank, but I have a shadow ledger that keeps track of how much of that total each one of those have. So just making sure everybody is kind of on the same page. So let's move now to a different question. And Brett, I'm going to throw this to you first. All right, so we got an FI and they're deciding, okay, I want to invest in fintech. What's the best balance that they have in terms of their role as a licensor? I want to get and acquire this, but they're also thinking about making an investment, right? So you have this partnership with a fintech as a licensor. We're going to partner maybe on a BaaS system versus I'm going to now invest in one. And if I'm investing in it and using it, now I've got some what I might want as a financial institution might run counter to what I might want as an investor. So give a crack at how banks should be thinking about that dynamic.
You know, what I always like about two-horn dilemmas is you go right through the middle of them. So literally for 10 years, we've done both. So as bankers know, you can use your holding company according to certain limits, and you can make seed level, and it's usually B series investments in things that you think have a great deal of potential for you. And then you can look at a wide set of things, especially through these funds that are out there, and be able to pick and choose who you want to do business with, which might be buying a service or might be partnering with them. So literally we have done both. And I don't do that venture capital, that's what that is, to make money. I do that to break even, but it's so that I can see all the things that are coming and know which ones that I want to attach to my platform and engage in. So that's the way we've attacked it for about the past decade.
Brett, I would tag along there. That idea that you can actually use some of the investing to fund that activity was part of our model when we developed it at Bank of America many, many moons ago.
I might have copied that somewhere.
Yeah, I would also add that from my perspective, as someone who's giving advice or counsel to FIs or fintechs, but in this case, FIs, I tend to lean or err towards partnering before sinking capital into any sort of investment. You also have to remember too that smaller financial institutions don't have the budgets for major investment. Larger institutions, have different challenges. A lot of the times, what they are concerned about is the fluidity of the regulatory environment. Mm-hmm. And that kind of gets to some other questions that I think are on the roster tonight. But just thinking about that in a little bit different way.
What I would say is that as a licensor, if there's a software solution, if there's a fintech company out there that has a solution that you think you may want and that you would license it, that is a separate decision from investment. So, yep. Sometimes it's difficult. You say, well, if I'm going to use it, why not invest in it? But my CEO of the bank is on the board of directors of this fintech company that we invested in. So I recently went and had a conversation with him about an issue on what I wanted the priority for a certain enhancement be. And he gave me his answer. And I stopped him. I said, wait, are you answering as CEO of First National Bankers Bank? Or are you answering as the board of directors? Right? It's like, mm-hmm. Wait, what kind of answer is that? But those are two different things, and so they can get confusing. So just kind of be aware of that. Let me remind everybody as you're listening in, if the thought hits you, don't forget to get that in the chat. And we're going to here in a little bit going to go look for any questions of yours that you've entered in, and so we're monitoring that. And I would encourage you to get those in as soon as possible. All right. Here's a new question. Adam, you take the first crack as this. So you're as a senior leader with near and midterm goals to achieve, how do you make decisions when so much of the world seems to be undergoing this fundamental shift of tech? And we talked about AI, politics, work from home, and all of these things. What's the decision matrix to say, here's where I can stand on solid ground?
Well, the first thing I'll say is that doing nothing is a non-starter. So you got to figure out how to move forward and grow your business. As it relates to some of the specific items that you mentioned, like work from home, I think that's largely a function of the type of business that you're operating. You know, for mine, a professional services business, that doesn't work. I've already learned that lesson. I learned it years ago. It's necessary for everybody who's on our team to be in office so we can share ideas in real time, and be nimble like that. As it relates to politics, I mean, I think we can all we all believe our government's good at one thing at least, and that's not being able to do much or do it quickly. And we see this across the board, especially in financial services and banking. You know, as it relates to, you know, crypto. I mean, I think everybody was very bullish going into this administration. I think there have been head fakes so far, maybe a little movement on stable coins, but other than that, not so much. But in terms of overall how I think about it, I think of short and intermediate goals, and I think of long-term goals. Long-term goals are usually associated with strategy. Short and intermediate are usually operational. And it's not like one or the other. It's dynamic. They both feed into one another. But, you know, if you're running a business, you always have to be mindful of, when I think of operational, my first thought is almost defensively. What do I need to be in business tomorrow, next week, 3 months from now, for the rest of the year? Am I achieving last year's strategic goals? Am I laying the groundwork for this year's strategic goals? And then strategy is further out. But I mean, timing, the biggest problem I see across the board is with the government and regulation. That is a major constraint. And you just got to figure out ways to work through it. I mean, quite frankly.
Well, Daniel or Brett, let me switch this around a little bit. From the first moment weeks ago when we first started talking about this session, we were doing some prep. We're, you know, right at the beginning of this new administration, and what we've seen, I think I'm safe in saying this, that the CFPB is significantly muted, if not on its deathbed, right? So let's just switch gears and talk about the CFPB for a minute, and whether or not the changes, because of the change in political climate, now suddenly opens up people or individuals or companies that might now move forward with a fintech venture in certain areas, simply because there's not the threat that a CFPB could be onerous regulations, or, you know, come down harshly on some new venture they might have.
So I'm happy to take a first stab at that. So there are two sides to that coin, right? It frees up the fintechs to maybe do and pursue things that maybe would have been shut down in a tighter regulatory environment. But on the flip side, when you look at the financial institutions themselves, right, they're still pretty risk averse. And what you've done is you've increased some uncertainty, right? I will get back to the 1033 rule and open banking and where that was going to go. And there was a lot of investment in and around that space and a lot of activity. Well, now that's all questionable, right? As to what that regulation, if that regulation is actually going to come into practice, it's looking highly unlikely that that's the case. So the point there being increased uncertainty in the near term, I think will cause people to kind of pull back a little bit.
Yeah, just a couple things. You know, CFPB clearly weakened, but I'm old enough to remember look backs are a thing. And so you have to remember that what's going to happen in the next 4 years is going to be looked at afterwards. And I can go back in history and see all those things. So don't get too excited yet. I would say on general regulatory environments, banking, huge relief coming, right? It's a tremendous relief. We're already feeling it and seeing it in many ways. In our specific place, not so much. Nobody's happy about consumer harm. The issues that happened with Evolve and what happened in that is completely unacceptable on either side of the aisle. And so we always have to have a mindset that says, forget the regulators, don't do the wrong thing. And that's really got to be a key part of anything we do.
Yeah, and I think it's fair. We have to, as the financial industry, if you will, financial services, we have to look at ourselves in some ways and say, hey, look, what the CFPB was doing was heavy-handed. And just using, say, overdrafts as just one example, I think what they were doing with overdrafts was extremely heavy-handed. Yep. But But in the age in which things were no longer manual, and yet overdraft fees had continued to creep up, and in many cases were $40, or something like that. So you can see where there was fodder, or there were certainly reasons for people to say, hey, we can go after this. We think this is this is out of bounds. So I think we can come up with fair ways in order to use the technology that we have to service our customers. And what I know is that people in their regular lives pay for convenience. They pay for things that are positive to them. And so there's no reason why financial institutions can't have a model that also has that kind of effect. I'm seeing even in payments this idea of the UPS. When I go into UPS, I take a box and they measure it and they say, okay, Mr. Peterson, when do you want this to, do you want this to get there next year, a couple of years from now, it's 10 cents, or no, we can send it to you in 5 days and it's this price, 2 days, next afternoon, today, how about like in the next 10 minutes, what it's like I get to choose the price that I'm paying based on the service, the level of service they're providing. Banks don't do that. And we've been sort of loath to kind of move to that model, but I do think it's something that we're likely to see as time goes on. Any other thoughts about this idea of the what's the way that banks and fintechs are going to make decisions in a changing environment? Have we used it all up?
David, I have one more comment.
Yeah.
And this is an overarching one. I mean, I think everybody understands that AI is a general purpose technology. It's not just banking or fintech. It's going to be everywhere. Every business in all of commerce, is going to be used. The regulatory overhang on that, I mean, hasn't even started yet.
Yep.
And that is going to be an issue. I mean, there are serious questions about privacy rights, whose data is being used to actually train these models, IP rights. And on the regulatory front, Congress, they haven't done anything on that yet. And I think that's going to be at some point problematic because there's a rush to get to the market with point solutions that rely on machine learning, that are addressing very specific issues for very specific types of businesses. And that makes it really tricky. I mean, there's a parallel in the crypto and the digital asset industry as well. When you don't know the rules of the game, it's very difficult to invest a lot of money and innovate. So I think it's something to be mindful of as well.
Adam,
Yeah, go ahead.
David, if I can just add on real quick. Coincidentally, I got an email from an executive at a top 5 bank this morning. And in the little footer to the meeting, it basically had a thing, you cannot record this meeting and use AI, right? So they've gone full tilt to one side. And it's very interesting because it's not just one bank. I've run into this with a lot of large enterprise where they've just said, I'm going to shut off the gates and we're not going to let AI in. That'll obviously change quickly.
Sure. And this came to my mind as we were just talking about the CFPB, but there is something else that's happening. And I'm just curious real quick if you guys think that all of the efforts of Doge and there's this huge effort now to we're going to come in and going to weed out inefficiencies, whatever, and they're talking about all of these things that USAID is doing or whatever else, and it makes me think: are there banking specific, are there fintech specific things that are likely to be affected by Doge going through and trying to trim this up, or are we as financial services not really tied to those different government agencies to receive funding and so forth? I couldn't resolve that in my mind. Do one of you three have a thought there?
I do think the regulators in general are going to be limited in their ability to respond. There's going to be fewer of them. We're already seeing some of them even leaving. And so that may slow some things down, even things like mergers and acquisitions, et cetera. But I don't think there'll be much of an impact in this specific space.
Got it. Okay, good. Because it's one of those things where it's like, I don't know where all these investments are being made and where money's coming from. All right, so let's tackle a little bit different, take a different tact here. So what I'm asking now, and Daniel, I'm going to ask you to lead us off on this question. Let's take it from the FI perspective. If you're an FI and you're looking to make a fintech, you're going to start a fintech subsidiary or you're going to invest in one. How are you going to measure success? How are you going to, through ROI or outcomes, whatever ways, there's got to be some way that you say, here's how we're going to define success for us. What are your thoughts there?
Well, I'm going to start out with a quote from a book that a good friend of mine wrote back in the 90s. And the quote, and it's been bastardized many times since, but it's basically think big, start small, and scale, right? So I think for anybody, especially a small to mid-sized institution that wants to start doing fintech investing, keep that to heart. Now, how do you measure success? It's you've got to be very, very, very specific. I think one of the things that we've seen over the last 30 years is being part of the fintech investing program has a relatively short shelf life, right? You see these things come and go, with probably about a 5-year plus or minus lifespan. And the key there is when you're beginning that process, define your goals very clearly. Make sure you front load some of the deals that you do that will be quick wins, because nothing gets you additional funding and provides cash back to the enterprise, Brett, as you said, to do other things like some quick wins. And understand that when you look at VC investing, you are not a VC investor. You may think you're a VC investor. You're not. VC investing is a very, very different mindset. It's funded a very, very different way. And a 1 out of 10 success rate there actually works in that environment. And I can guarantee you that's not going to work in a banking environment. Okay. So you've got to make sure that's well understood up front. The other biggest piece of advice is sort of probably the oldest advice in investing is don't throw good money after bad. I see that all too often. And the way you avoid that, by the way, is when you're making the investment, as you're going through and actually do a formal investment memorandum. And by the way, you sure as heck should be doing that, right? You need to make sure there are key milestones in there. And if you're not hitting the milestones, you shouldn't be making additional investments. And then finally, again, that 1 out of 10 batting average is very good in the venture world. In the fintech investing world, you need more of a major league batting average.
Nice. I don't understand. I accept that the sunk cost fallacy is almost impossible to overcome, but I don't understand why it should be that hard to throw good money after bad.
David, as somebody who has walked into the CFO of one of the largest banks in the country and had to explain why I was writing off a particular investment, it's not fun.
Brett or Adam, any thoughts here?
Again, and the way I measure this personally internally is access and awareness. And the reason is it's moving so fast. And as a banker that's trying to play in this space, just being able to know what is out there. So this is, you invest in a fund of funds and you see 100 things that are out there, because then you get access and then you begin to be able to make choices about it. The danger for me is some technology gets away and out long before I know about it, and then I get left behind. And that's really what my focus has been here.
And from my perspective, David, this is within the context of advising fintechs who come to us, typically looking to raise capital. I mean, our quick assessment is essentially, customer acquisition. Who's gaining market share, who is not gaining market share. And ultimately, there has to be a road to profitability. And, I'm not sure if it's known on the panel, but I mean, coming out of, during the pandemic, profitability didn't matter. It was growth at any cost. Now profitability, I mean, if you're beyond an 18-month window, you're toast. So you can't raise off that. So, but that's specific to my business and advising, earlier stage fintechs in terms of how I evaluate them and whether or not they're successful or not, or are likely to be successful.
Sure. And Daniel, thinking about the quote, about start small and scale.
Yeah.
This idea of a company or a bank saying, hey, look, instead of us making a big investment in this fintech, why don't we just kind of make smaller? Why don't we just take little bites? We can go and here, and here. But then doesn't that potentially create its own problem where now you're dealing with 6 or 8 different fintechs who've made small investments versus maybe pushing chips all in on one. So
Well,
are those really two sides of the same coin?
Well, remember the success ratio, right? I mean, these firms ultimately are VC invested, more than likely.
Right.
I think I could count on one hand the number of investments we made where we weren't co-investing with venture capital, right? And by the way, I think that's a good recommendation. If you don't have other venture investors who are willing to come in, you need to be really seriously thinking about why you're investing. And again, making those small investments to Brett's point, what the value in this investing program is, I called it a downward pointing radar, right? Because what I was really concerned about was disruptive innovation that was going to come eat my lunch, right? So I wanted to see that early. Even if the investment didn't play out, I wanted to see it coming. I mean, I'll say there was a very large payment company that I can't name because I still think I'm not allowed to, that we had an opportunity to do a Series A investment in, right? But the business unit looked at it and said, I'm not willing to do this because it's going to actually eat into my existing business model. And it's kind of like, I'm sorry, but I threw up my hands and said, oh, something, a bad word. And we'll tell you that investment, had we made it, would have been one of the most successful ones we would have been able to do. So, but again, that visibility into what was happening, it put that on the radar for us. So even though we didn't make the investment, we became very aware with what was happening and did some other things that we were doing internally. Because again, remember this, when you're looking at why are you investing in fintech, right? You always need to be asking yourself that. You need to be looking at opportunities, always within banks, right? It's a build versus buy conversation. So there's that vendor piece of it. And it's sort of like, well, I ran into this week actually with another top 10 bank. And their comment was, well, we can build this. Well, my standard answer, even 30 years ago, by the way, was, yeah, we could build this when I was at a bank, and it'll take us 18 months and $18 million, right? And do we really want to go make that investment to compete there? And then the last piece that I will say is this investing function, it's not always an investment, right? There's stuff that you're not going to do that you learn from that's probably as valuable, if not more so, than making the investment. And there's also, I look at when I was running my team, our biggest financial return, and this is public info, was we actually spun out some bill payment technology to CheckFree. And as a result of doing that deal, we earned 17% of the company's outstanding stock. Right?
Nice.
That kind of deal is not a bad deal. So those are the things that you could also be looking at. So again, I think that you take off this, it's this idea of understanding the emerging tech, understanding what threats are coming, understanding you want to partner with somebody, do you invest in it, do you want to take some technology that you've developed and actually spin it out? Because by the way, most financial institutions aren't really that good at product development. And I'll give you the perfect example with the ECNs. When there were a whole bunch of marketplaces that were digitizing, we invested in like a dozen of those. Those were very successful because that technology didn't belong in an individual bank. It was more of a utility.
Yeah. You have to at least accept what business you're in. If you're a financial institution,
right?
Are you a financial institution or are you a fintech company, right? If you're going to go build or get a subsidiary. Correct. So FNBB has a technology stack, the electronic product that connects all of those 680, whatever number of banks there are. And we outsource that to a company in North Carolina. And I have to constantly remind our C-suite, we are a technology company. We have our own software and our own code. Just because you outsource it to those groups over there, it doesn't absolve you of all of the responsibilities. You just don't have your own programmers and quality assurance, people and everything else. All right, so we're getting down here to where we can take maybe a couple of questions. And so, Derek, I think you've been monitoring, and I see a question here. It says how, and this, I'll just throw this open, and any of you three, if you have a word here about this. The question is how do you see tokenized ID and payment enablement from companies like Apple impacting the fintech space?
Well, I mean, I think identification, authentication, fraud prevention, this is ripe for all kinds of solutions, right, that we need to have. And this is also a big regulatory thing. We got to break the regulators' dependency on CIP and all those kinds of things, and get much more to those kinds of identification measures. That's the way we're going to solve convenience, fraud, all of that, and make it much more efficient. So all of those are going to be huge opportunities. The winners are not yet known. There's going to be a lot of players.
And that goes back to making investments in a number of things, because you don't know who's going to win that game. And by the way, that game's been playing out for 30 years. It's really not new.
Right.
Yeah. What I do know is I don't know how many years it's been now, but the OCC came out and said, hey, we're going to allow a fintech to get a special bank charter. And, all of the banks, of course, lost their minds and said, oh my gosh, this is the end of the world and so forth. But I think, there's a handful. I don't even think there's 5 fintechs. There may only be a couple that went through that. And as it turns out, it's really hard. If you really want to be a bank and have your own FRP ABA number, it is a pain in the ass. And so the fintechs don't really want to be that, right? They want to find ways to collaborate. And so that's where, as Adam talks about banking as a service, there's ways that you can find that collaborative way to work with a fintech and decide how you're going to do branding and whether or not you have your own bank and it's got its own online banking and mobile banking and it's branded. But now you have this online sort of a virtual bank and it's called something else. There's all kinds of ways that you can look at doing this and finding that, that proper collaboration. All right, let's take another question. Here's a little bit different a take. Somebody asks, any insights on investing in a nonprofit-based startup? A nonprofit. So obviously, Dan, you were talking about the need to make sure that we're driving towards profitability. What about a nonprofit startup? Is that something worth consideration?
I think it could, but the terminology there, I would say it's not an investment per se. It's a partnership with the nonprofit.
That's right. Yeah, remember our theme is and purpose, financial inclusion for all. And a lot of that is engaging with nonprofits in a partnership way to provide education tools and those kinds of things to help people. So I love it, but you don't do it for gain because you're not going to. You're doing it to provide a service.
Yep.
Yeah. I was recently came across a company that basically is placing tranches of $250,000 CDs at regular CD rates on behalf of companies that have a lot of excess cash. Think PayPal. And so it just so happens, the magic 200. Oh, gee, why would that number be 250,000, right? And so basically, it's like a community reinvestment. If you're doing good things in your community, we'd like to put 250,000, and because it's not brokered, it's just at whatever the regular rates are. So there's inventive things going on out there that aren't necessarily hugely technological, but obviously serves a niche, perhaps at a time when banks were looking for $250,000 or more in CDs. All right, let's look at another question. Okay, here's somebody who says, I work in a large global FI as a fintech subject matter expert, where fintechs are a new space for their FI. Our legacy systems and technology is playing catch up to meet the demands of our fintech clients, often developing band-aid solutions. How do you see large FIs solving this gap? Do you develop brand new systems and invest in technology, which is not always the easiest solution for a large FI, or continue applying band-aid solutions, which in this person's view is not feasible in the long term? I'm not even exactly sure if it's feasible in the short term, but that's a good narrative with very specific information. So what do you guys think?
I'll start with that. I'll go back to 1033 and open banking, because it was headed in that direction, right? Where the banks were going to be required to provide the data to fintechs and to customers and so on. And that's really the key, is you've got to, and Brett said this very well earlier, right? You've got to have access to the data. And if you have access to the data, you can make that work. But that's still the biggest sticking point. When we're doing implementations with some of the partners that we work with now, that's really it. And a fintech will normally have a pretty well developed open RESTful open API model, GraphQL, all of that wonderful stuff, right, to make it easy to integrate. And when you go back into a legacy system, we were chatting with another top 10 bank that you'd recognize that on the account analysis side, and their legacy system, by the way, that's running that is 50 years old plus.
50 years old.
Yeah, Adam used a term that is really important to this, especially for all the bankers in the room, which is the term sidecar. So technology has changed in such a way that you can go build for whatever your current need is, and you can make your bank technology native and begin to engage in that way. You're still running your old, and then you can migrate it slowly over time. The days of the big bang are over. Those are way too risky anyway. And it lets you do something fairly quickly. It may just be business services and an API that's going out, right? Very quick kinds of things that begin that process. What's being described here is what I call putting lipstick on a pig. It's not going to work.
Adam, thoughts?
That same situation is analogous to the payments processing space. I mean, you have the same thing going on there. The major processors are all running legacy systems. Many of them, if you really peel the onion, you're gonna find software running on mainframes. I mean, J.P. Morgan Chase, I think, has 7 cores, maybe 7 banking cores that they use. I think it just recently they added their first cloud native one, and the rest of them are, if you dig down, they're running on mainframes. So it's a very difficult problem and challenge for the banks themselves, because again, it's very resource intensive to make that transition if you're going to commit to it. And it's not just money, it's time. And that time is not months. It's probably most likely years. It could take years to make that transition. But Brett described it very accurately with the sidecar model, where you kind of you start transitioning your old to your new, and you start slowly navigating specific point solutions over to the new, and ultimately you get them all over. It's definitely a feasible model, but it's something that needs to be discussed internally, and it definitely is a challenge.
I have to laugh because as chief innovation officer in 40 plus years in this business, the kind of issue that this individual raises, I'm like, oh no, we're not gonna band-aid this, so we're gonna do this right. We're gonna figure out not just how to fix this, but have it be very flexible. It's gonna have all these options to address future things. And then I remember back during my days as CEO as Goldleaf, we basically created in the early days of Windows 3.1. So we're going back now to 1999, 2000. We're like, hey, let's do a prototype. Let's just create something, because we don't know if bankers are even gonna use this stuff, whatever. It'll just be a prototype. We'll give it to a few of our close banks, and we'll see if it works. And we had 10,000 users, 10,000 people using that software, and we thought, oh wait, maybe we should actually build a real application. This was just a Band-Aid. So I have to realize that when you're in the mode, you get consumed with all of that. Okay, there's one last question. Let's see if we can shoehorn it in. As AI and Gen AI continue to evolve, how do you foresee the integration into banking as a service? How do those platforms, enhance financial product customization and scalability, but democratizing access to advanced banking services? So real quick, any thoughts there?
Yeah, I mean, I'll take a shot at this. The big thing in banking as a service, everybody's been talking about the ledger, which is sort of the headline right now, but it's really third-party management and nested third parties and fourth parties and fifth parties. One of the very early use cases in banking as a service is going to be the monitoring of all those third parties in a compliant way to be sure they're doing what they're supposed to be doing. When you have partners that have partners that have partners, you can't do that job without effective technology doing it. So I think that's one huge place where AI is going to come in and help.
I'll give another ancient AI story. So back in the day, I had the opportunity to invest in what we now call an AI company. It was called Financial Engines, and it was offering basically financial advice. And it was actually founded by a Nobel Prize winner who actually created the efficient frontier for investing. And he came to me actually through our CEO's office. And so it's always fun, by the way, when you're directed to a Nobel Prize winner by your CEO, and you have to figure out if you're going to invest in his company. By the way, we didn't. And the reason we didn't is it was because how could his AI model of creating this efficient frontier for an everyday investor, how the heck were you ever going to explain that? As it turned out, 10 years later, the company actually did pretty well but it's because they did what venture funded companies do. They pivoted, and then ERISA laws were passed, and it became important for employers to actually get investment advice off to employees in a way where they weren't going to get sued to hell and back. And that actually did it.
Yeah. Awesome. Well, listen, I know there's some more questions that are coming in the chat, but we're running up against the top of the hour. We want to be respectful of time. So, Derek, I'm going to pass it back to you in just a minute for us to do our breakout sessions. But let me just give one last little quick final question to our three panelists. And this needs to be pithy, right? So this is going to be one or two sentences, like boom, boom, boom. So, Adam, we'll start with you. What's your best advice for financial institutions that have yet to engage with a fintech investment, but who are considering it? Your wisdom is?
Consider your customer needs and get out there and start talking to as many different new fintechs as possible.
Beautiful. Daniel?
Think big, start small, and scale.
Love it. Brett?
Invest in a fund of funds so you get access to a lot of different things to help learn.
Awesome. And I'll throw my little 2 cents in. I have a thinking room at First National Bankers Bank. I was trying to think of what slogan I wanted to put up in big letters. And I came up with innovation occurs when failure is an option. And this is a problem for banks because we don't accept failure. When I was a member of the board of directors, we spent more time talking about teller over and short than we did asset liability management. So we don't like failure, but if you're going to get in and get your hands dirty and start working with fintechs, you're going to make some mistakes. You have to be able to start small, iterate, make some mistakes, figure out how to fix those, and that's going to allow you to be successful. So Daniel, Adam, and Brett, I really thank you for your wisdom. I know we've got some breakout sessions so the conversation can continue. So Derek and Ron, I will turn it back over to you.